All right. Hello, everybody. My name is Zach. I am the CEO here at Pension Consultants. You've joined the RetireAdvisers Podcast. Thank you for taking time out of your day to be with us. I am joined by
Michaela Hutchison. I'm the RetireAdvisers Manager.
Fantastic. So we've got a pretty full agenda today. Our main topic that we'll discuss is annuities, which is very exciting. So I know that that's a question. I don't know. For me, it comes up more with certain demographics. I feel like there's some small towns where, the annuity salesmen have really got a pretty tight grip on the community. So I see it with some groups. It's a bigger question than maybe with other ones. Is that fair to say from your perspective?
I do feel like that's fair. Yeah.
Yeah. So we'll kind of give our thoughts on all of that, and we have a really nice article that our team has written accompanying that. And we're also going to cover some of the latest updates with what's going on in the world and what's going on in markets. And hopefully the goal is to give some time-tested guidance on how to think about this as investors, as individuals preparing for retirement, or maybe individuals as well that are in retirement, those of you that are lucky enough to be in that position. So does that sound good, Michaela?
Sounds like a plan.
Awesome. So I wanted to first start off, I have this Bloomberg article, and it's from this morning. So this is hot off the presses, and it's always a little bit, it's a little bit risky. And I guess I'll say this because I said this last time. Today's April 17th. Is the date that we're recording this. And so, it's always a little risky from our perspective because it takes a couple weeks for stuff to come out and things move quickly, right? So we're not going to say anything too definitive about the situation and what's going on, but I do think there is some good lessons anytime there's, some anxiety in markets or there's just things are moving really quickly. It's, as investors, how should we think about this? How should we wrap our head around it? And so the big news this morning, I'll just read kind of the bullet point takeaways from the article. And number one, it's Donald Trump said Iran agreed to suspend its nuclear program indefinitely. So that's political, that's geopolitical. We don't have to get into that too much. He also said a deal to end the war is mostly complete and talks over the lasting agreement will, quote, probably be held this weekend. Okay, that's a little more applicable from an investor's perspective, or at least something to think about. And then lastly, I think the big news was the Strait of Hormuz. Iran said it would be left open for the duration of the 10-day ceasefire between Israel and Lebanon. But the U.S. blockade on vessels transmitting to and from Iranian ports would stay in place until a broader deal was agreed. And so, the big news is I think, there's been so much uncertainty around the Strait of Hormuz and, the passage of oil through there, the impact that that's had on energy markets. And this is kind of the first time I think Iran has had any official confirmation on the state of the situation. And so oil prices have dropped. I don't know where they're at as of this exact moment, but they were sitting below $90 a barrel, which in general, we haven't been at these levels since the start of all of this, basically. So kind of a big deal. Before I get into kind of all my thoughts and different things knocking around my head, do you have any, what do you think from your perspective, Michaela, if people are coming to you and your team and asking, my goodness, we've got this very fast moving situation. There's a lot of stuff going on. What do you think is what should we do as investors in general?
Yeah, that's a really good question. It's so funny because I feel like the last time we met, the market was down, and there was this kind of like a vibe of oh, this could last a while. And it's only been a couple weeks. And now we're talking about all-time highs, right? We're kind of back to before this all started. And so what I would tell someone is you really need to create your portfolio to last the long term for different market climates. And, it is that simple. You've got to be diversified. So that's what I would say.
Right. Yeah, that's great. I always think like in general, if you're below 40, like, and probably if you're below 50 for a lot of folks, like turn the phone off, like just let
Right.
it ride. I mean, if your time horizon before retirement is 15, 20 years out, I mean, there is no need at any point to go in and try to trade through these types of
Right.
situations. And
Specifically, I didn't mean to interrupt you,
no, go
but
for it.
for retirement plans, because those are built for the long term.
Right.
It's not like a brokerage account. So absolutely, I
Hmm.
agree with that.
Yeah, like you can't trade those accounts. Like
Right.
they're mutual funds, and that maybe some people aren't fully aware of this, but generally retirement plans have you use mutual funds, and those strike a daily NAV, net asset value. And so when you put your trade in, assuming it's sometime before market close, and maybe there's some variance in terms of what the exact time cutoff is for record keepers, but your trade, is at best going to be, ultimately transacted that evening, or if it's too late in the day, it's going to be transacted tomorrow, after market close at that point. And so, yeah, they're not built for,
Timing the market.
yeah, like let me click it right now. Perfect, I'm in.
Right.
Um, and it is with that idea of you don't need to, you shouldn't. I went on a walk over lunch and I was kind of thinking through like if you're an investor, you're thinking more in terms of what are the set of outcomes that are in front of me? Are they good outcomes? Are they bad outcomes? And am I okay in each of those different types of situations? And if I'm not, that's where I want to make some changes to manage that risk. A trader, TRADER, not traitor, um, which by the way, I go to fund companies. I try that joke on them, and it rarely lands. Um, that's where you're getting more into, what's the market pricing in? Is that the correct assessment of the probabilities? And then you try to, dance around that a little bit. And that's a game that very few people do well. And so for most everybody watching, the game is, well, is retirement really far out? Okay, I need to not worry about this kind of stuff. If I'm close to retirement, I should think about it and I should evaluate the situation, but more in terms of worst case scenario, what does that look like for markets, for my portfolio, and is that a situation I can handle? And if not, maybe I should make some changes. But if you've done everything correctly going into the situation, you're okay. You've already prepared for this to some degree, and but certainly fast moving. It wouldn't be any surprise to much of anybody at this point if over the weekend some terrible news came out and
Right.
oil comes right back up and the stock market comes marching right back down. So, yeah, have any quick thoughts on all of that?
No, I think that's absolutely correct. I was reading an article. I'll have to get to you guys, but it was talking about how America hasn't been really affected by what has been happening
Mm-hmm.
over there in Iran, but a lot of our trade partners, Germany, Vietnam, do you think some of the trouble that they are seeing now could trickle down, even though we're kind of on this high today?
Um, yeah, I don't know. I think there's a lot of like the U.S. is in a good position from a you know energy neutrality perspective. It's like we produce enough of our own energy that um, the energy shortage type scenario is not as likely here. Where if you're and I don't know enough of the statistics off the top of my head, but there's a lot of European countries where they import almost all of their
That's
energy,
right.
and so yeah, they're at a bigger risk. But I think what you're seeing, there's China, for example, imports a lot of energy, and I was looking this morning. What's the top performing um, sector of the global stock market, or I guess country, emerging markets are outperforming developed markets so far this year. And what you saw through energy prices going way up is, China sold off a ton, emerging markets sold off a ton, these energy importers. But they've also been the biggest to rebound now that, things are looking a little better. So yeah, there's definitely some disparity in terms of how different countries might respond to this. I think as far as looking forward, what are the things that people are going to be, what's going to matter most for investors over the next, call it 6 to 12 months? I think the big unknown, if energy prices continue to stay low, is going to be how much of this energy shock has already started to trickle its way into non-energy related goods and services. And so there's the inflation, there's the baskets of inflation, there's core inflation, and then there's food and energy inflation. So the Federal Reserve is often looking at these two different baskets, and they often kind of set the food and energy aside because it's really volatile. It's 1 month it's up, 1 month it's down. So they're often looking at core. And so the question is, well, if you get enough volatility here, energy is an input into just about everything. So do you see enough of that kind of work its way into kind of more broad-based inflation? And that would have a big impact on fixed income investors, on, potentially equity prices, with a little bit of cost pressure working its way into there. So I think that's kind of the next, again, assuming we're out of the woods, and we are absolutely not out of the woods, but I think that would be the next thing to think about and to process. Again, if I have a fixed income portfolio and inflation goes up to 4%, what impact does that have on my portfolio? And is that the situation in which I'm still okay? Are you seeing much people talk about inflation, and is that a conversation that's being had very much? I know people are talking about gas prices, but are you seeing that broader kind of inflation talk yet?
Surprisingly, no, I haven't.
Mm-hmm.
But I'm sure it is on top of everyone's mind, especially with the gas prices. But
yeah, great. Well, you had a few other kind of things to discuss from your end. So
yeah, one of my articles was just talking about again how well the market is performing today, which again is April 17th. And then there's also this other side of like, well, don't get too relaxed because the ceasefire is only until basically the end of April. But I think that I cover the fact that it's going to be up and it's going to be down. And it really is about creating a portfolio that can withstand the different market changes. And you really need to be thinking about how close you are to retirement when defining your portfolio. I mean, do you agree with that?
Yeah, 100%, 100%. Yeah, I like we've got a few different studies that we've looked at, in the past. Like there's that the CGM Focus Fund. I think that's in our heading into retirement presentation, and it's just just identifying this pattern of almost all investors are so bad at timing these things.
Right.
And normally the timing is just about the exact worst time.
Right.
Like the moment you finally say, you know what, I've had enough. Today's the day. I'm going to call up the broker, the record keeper, whoever, and I'm going to finally move to cash. Like, it's kind of uncanny that's often like the moment when, things have finally turned around, and, and that can also happen on the upside too. You see this a lot with, different technology companies, the hot new stock, right? Which I don't hear as much talk about, but if the markets continue like this, it's only a matter of time before, all of a sudden everybody's talking about some random tech company
Right.
you never heard of until now, but now all of a sudden everybody's talking about it. And, there's, I guess, some IPOs and things that are slated. And, the time that you're finally like, you know what? I've heard enough of this. I think I'm ready to invest. I'm picking up the phone. I'm going to buy some of that stock. It's like that's.
And the price is already super high.
Right. Yeah. It's like that's the moment where it's like, okay, you were the last person. Congratulations to buy this thing. And now there's nobody else in line to buy the stock and only a bunch of people that are in line to sell it, And that's through all of this, any volatility, if things are really bad or appear or feel really bad, that's the gut check that you've got to think about is like, you're probably not very good at timing these things. I mean, by the way, this is something I've got to look in the mirror and tell myself, as well. I'm not immune to this in any way, look myself in the mirror and say, you're probably really bad at timing these things.
Yeah.
Whatever emotion you're feeling, whether it's, you're feeling bad or you're feeling great. It's like, that's not the right way to do this.
Right. It's what you know. I always say, it's not what you think, it's not what you feel, it's what you know. Because there is an interesting psychological aspect, I think, to investing. And it is kind of like, well, I feel a certain way because I read this, article. And it's funny because you can go and look up that same topic and you'll see an article that kind of disputes it. So, So how do you combat it, those biases that you have or those gut feelings? Is it just research? Is it...
I think the right answer is process. Deciding on a process ahead of time and following the process. Our team does a lot of research on mutual fund companies, and a big part of our role as a company is going out and selecting those mutual funds for the retirement plans. And so, what you're looking for in those fund companies is probably the same thing that you should look for in yourself to develop a good investment program. And it's, what's your strategy, what's your process, and how good of a strategy and process is that, and how likely are you to actually follow it. And a bad strategy is, well, I know what I'm doing, and we'll just kind of wait and whatever I'm feeling in the moment, like that's a bad strategy. But a lot of what we're talking about here, well, these are the foundations, these are the principles to develop a good investment strategy. It's what are, over the past 20, 30, 40 years, what have been the allocations that make sense from a return perspective if you're younger and that's what matters to you, and then also from a risk perspective if you're closer to retirement, and what have been those allocations that have gotten people into a lot of trouble. Avoid those, and if you're young, what would have been the bad allocations to have over the past 20, 30, 40 years, probably avoid those as well. And I think that's the starting point. Those are the principles. And we could go on and on about diversification and all that kind of stuff, but sticking to those and not getting caught up in the moment, and
See, I like that. So for you, it's about the process. It's not about, oh, what's happening in the market today. It's more like, okay, how am I going to determine what's a good fund or what's a good strategy, and utilize that process over and over again.
Right.
Yeah, that's really cool.
Yeah, and then I think if you're young, you care more about return than you care about risk. If you're near retirement and you're older, you care more about risk than you do about return. And they both matter in both situations, but it's in terms of priority. And if you're worried about risk, the right thing to do through moments like this are to, again, evaluate those outcomes. What's worst case? Like we've done these things internally where we say, okay, given what's going on, if we just assume worst case scenario in Iran, how high does the price of oil get? What's the impact and flow through on inflation? What impact would that have on a fixed income portfolio? Or our client, would that be a doomsday scenario for our clients, or would that be more of a okay kind of scenario? And for the folks where that's really bad, okay, we need to go back to the drawing board and review and update those allocations because we don't want to have to deal with that. Like the client doesn't want to have to deal with that. But if it's like, hey, worst case scenario here, we're still in good shape, well, then there is no need to go in and try to
adjust.
Try to predict everything that's going to happen. Yeah. So, I feel like a lot of this financial guidance and perspective, it's often kind of a broken record, but and part of that is because it's so easy to say, but it's so hard to do.
Right. Yeah. And the reality, actually, it's a good point because I talked about this earlier with you before we did this about this article I read about Netflix, how the stock isn't doing too hot. First quarter, they had great earnings. And then, people are saying, well, go ahead and buy. Some analysts are like, go buy into it, even though the stock itself isn't looking too good. And, again, when trying to determine, is this something I want to utilize if you're looking for an individual stock? I guess it goes back to that process. And it's like you said, the process is kind of easy. The information or the concepts are easy, but just putting it in practice, I think, is the hard part.
Right. Yeah. It's easy to kind of nod your head along to all of this kind of stuff,
right.
But until you're late at night reading a bunch of articles, getting really worried, it's that's where you really put everything to the test. And then at the same flip side, if there's analysts that are saying, now's the right time to buy in, that can also be,
right.
for the right kind of person, that can be really tempting as well.
Right.
And, and there's room for that kind of stuff. There can be room for that kind of stuff in a portfolio. But again, the process is what guardrails do we put around it? Because what you don't want to do is say, well, I have a strong opinion about this stock. I'm going to put 100% of my money into it.
Right.
Because, it could go to zero. And maybe you don't want that.
Yeah. So there needs to be some checks and balances. And I guess that's when you would probably want an advisor or work with someone to kind of check you maybe if you are really into investing to make sure you're not. What do you think about that?
Yeah, well, what a great opportunity to plug us and what we can do. But seriously, that is, the advantage that a professional has. It's one step removed from it being as personal to you.
Right.
If it's a professional that knows what they're doing, they're one step removed from the emotion of it.
Right.
I'd be lying if I said I didn't feel some sort of emotion too. It's a lot of responsibility.
Of course.
Managing portfolios for somebody else, but yeah, it's less susceptible to a lot of those same emotions somebody might feel.
Those knee-jerk reactions.
Yeah. And as long as you're working with somebody that somebody that knows what they're doing, and somebody that you can trust, that can be a big source of confidence, through times like these. And we have clients that have been with us for a very, very long time, and have been through, difficult moments like 2008. And they just don't. This kind of stuff just doesn't. They've been there, done that, and
right.
They know that on the other side, everything's okay,
Right.
and. So that also that can be a big peace of mind, working with somebody, but it has to be somebody that you trust and
right.
That you have confidence in.
For sure.
So annuities this is a big topic. One that I know comes up from time to time. For some, I feel like for more rural areas of the country. In rural areas where there's like one insurance salesman that has like really cornered the market, like that's where, the conversation around annuities becomes a lot more intense. I feel like annuities in general, maybe it's just the circle I'm in, but I feel like it's getting asked about less. I feel like there's less people that are interested in buying annuities. And I don't know, if I just think of the course of my career, I felt like it used to be such a big topic. And maybe, I don't know, maybe that we're turning the corner where people just don't care about this stuff as much. Am I off base or?
It's not like a very common question, but I do run into it quite a bit. But I've worked directly with a smaller community in Joplin, Missouri. So,
Yeah.
yeah, I do hear things about annuities, which I think is definitely could be a part of being diverse when it comes to retirement planning. I think the question really becomes, do you want it to be the main source of your retirement funds?
Mm-hmm.
I think that's what we should maybe talk about.
Right.
Because there's definitely benefits, but there's also these I don't know, not cons, but maybe a loss of opportunity.
Right. Yeah. The first thing I'll say is they are very complicated products. And they're sold by policy. So a mutual fund is sold by prospectus, meaning, for that mutual fund, there's different share classes, but it's all representing the same portfolio, the same strategy.
The same objective.
Right. For annuities, well, it's a contract essentially between you and the insurance company. And so, like any contract, you put whatever you want in there. The only limitation is the English language. And for that reason, it becomes a little difficult to talk just about annuities broadly because there's so many different types. So there's fixed annuity, there's variable annuities, there's fixed index annuities, there's immediate annuities, there's deferred annuities, and then there's all these riders that you can add to these contracts to say, well, okay, well, you don't like that feature. I tell you what, why don't we add this rider and we'll deal with that. And before you know it, it becomes quite a bit to wrap your head around. Often when we're talking about annuities, there's, at least in my mind, the kind of more, there's an argument to be made type of annuity. It's going to be more on your fixed annuities and your immediate annuity. And so, the immediate annuity is designed to, at its core, they're designed to deal with longevity risk. Hey, we, the insurance company, will pay out some fixed monthly amount for the rest of your life.
Right.
And since nobody knows when that's going to be, that could be a great thing. It could not be a great thing. It could be the best deal of your life. It could be not. And so that's kind of where there's some legitimacy to annuities. That, in my opinion, is where it stops. Everything else from there is just about like, why are we doing this? There's so many other options out there to address the same thing with none of the with almost none of the limitations. I got to be careful because compliance is going to be watching this afterwards. With almost none of the limitations, much lower fees, more transparency, more liquidity. There's often a better solution somewhere else. And then when it comes to the longevity component, which will, as we kind of piece this apart, there's a lot of better ways to deal with that as well, in my opinion. So before I just start rambling for a bunch of minutes, and what thoughts do you have on all of that? And or maybe do you feel like it's clear, when people say, when you're talking with people that are talking about annuities, is it even clear in their mind what type of annuity they're talking about?
No, I will say that. And I'm like, oh, what type of account? Like, I don't know. And I think it's really important because I think it gets lost that this is an insurance product. Like, and that's, again, to decrease any risk of a long retirement, long life lived. And so I wouldn't think of it as necessarily a retirement plan. It's really this insurance product that you're utilizing to make sure that there's some stream of income that's coming in that's not related maybe to your 401k or, Social Security. But like I said, there's nice things and there's not so nice things, and I'd like to go ahead and get into it.
So annuities are sold so aggressively. One thing that you mentioned is, they're almost sold as the plan,
Correct.
And we've just talked about diversification. You want to spread your money around a lot of different types of investments. And if you do that well, you can set it and forget it. When it comes to annuities, they're sold as the solution. And so what you find, at least in my experience, when you come across people that have, come under the spell of an annuity salesperson, is you look into their whole portfolio and it's just 100% annuities.
Yes.
And it's 100% of one type of annuity.
Right. And it's a lot of money.
Right.
Like $1 million.
Mm-hmm. Right. And they're sold so aggressively, and okay, why are they sold so aggressively? Well, the payout on selling an annuity to somebody, if you're an insurance agent or you're some broker selling these types of products, the commission is immense, and so if you're able to sell $1 million worth of annuities, I won't make any specific speculations about how much it is, but it's easily a 5-digit number. And, it's certainly one where you're going out to a very nice steak dinner that evening to celebrate. And, well, how do they pay out such rich, extravagant commissions? Well, they have these surrender charges, surrender periods, right? So the second you sign on the dotted line for the vast majority of annuities, like I'm thinking like fixed annuities, immediate annuities, there's going to be a 92, 95% surrender period where you immediately give up 5 to 10%, sometimes even more of your portfolio, where you say, you call up the insurance agent the day after and you're like, I've made a terrible decision, I want my money back. And they go, okay, I tell you what, I can give you 90 cents on the dollar, And you're like, what? I just lost 10% of my money. Well, so those surrender charges enable the insurance companies to pay out these extravagant commissions because they know that the insurance company knows and can guarantee that they themselves are going to earn a nice return off of this new policy. And so if I even just like go down through the list, and I don't want to just kind of ramble on too much, but let me just talk about briefly the fixed annuity and the variable annuity. So on the fixed annuity, this is a guaranteed interest rate. So okay, Michaela, over the next 5 years, you give me some money, and over the next 5 years, I'll pay you some interest, and then I'll give you your money back at the end. And the insurance company says, hey, this is no risk, right? We guarantee you your money back. What does that sound like to you?
Well, I can tell you what it would sound like as a conservative investor. That would sound like a great opportunity.
Sounds pretty good.
Yeah, it does sound good. But then I would wonder now, as me, could I be getting a better return?
It sounds a lot like a bond to me. It sounds like just normal run-of-the-mill fixed income, So I could go to the United States Treasury and I could offer them a similar arrangement, and they would accept that. There's corporations out there that are looking to borrow money. They would accept a similar arrangement. Your bank, you could go to the bank and get a CD. And depending on who you're lending to, like the U.S. government, for example, you'll get a decent rate of return, at least now. And then they're incredibly liquid too. Yeah. So if you have that gut feeling in the middle of the night, you go, my goodness, I've made a terrible mistake here. You wake up tomorrow and you just sell it and you get your money back. So the insurance companies, in my opinion, have offered through the fixed annuity something that is basically just a fixed income product with, again, speaking from experience, I had a client that came on with a fixed annuity paying 3%, and interest rates are now closer to 4.5%. And so they were getting a worse deal. And oh, by the way, he still has a big chunk of that fixed annuity because there's a 95%, 96% surrender charge.
Yeah.
And so it's like, well, I don't get the argument for this at all, because you could have got the exact same thing with none of the downside and all the optionality to change your mind down the road if you wanted to do something different, just through, boring old U.S. Treasury or something like that. So they're kind of like, again, that's kind of a product that's dependent upon you not knowing that there's some alternative out there that might be better, So don't love that. And then you often might see variable annuities, for example. That's maybe the kind of like second most common that we see. At least people that are preparing for retirement, that own annuities, that haven't retired yet, but they're working towards it. And those are sold as, there often might be some riders built into that, where it's like, well, we'll guarantee if the market drops below 10% or something like that, we'll cover you. Like you don't have to.
You'll get a minimum amount. Yeah.
Right. But often to compensate that, there's also a maximum amount as well.
That's right.
And so there's no free lunch. You often would be better off just, if you don't want to take on much risk, don't have 100% equity, pull some equity risk out here, put it in fixed income, have that diversified portfolio. Again, the exact same thing.
Right.
And variable annuities, and a lot of these annuities often have, where there's an explicit fee defined, they often have some, there's like with variable annuities, there's the base fee on these investments, which might be 1% to 2%. And so, you think about how much it might cost to hire somebody to manage a portfolio for you, or just the cost of mutual funds in general. They're often way, way lower than what you're seeing in variable annuities.
Yeah, when I read up on annuities, I think it was last year, and I was just like, my mind was blown, because I'm like, okay, if whatever they put you in did X, you're gonna get way less than X, because there's a maximum that you can take.
Right.
And it's confusing.
Mm-hmm.
And so as a normal person that just wants to have money for retirement, it makes you feel uneasy. You know what I mean?
Right.
And I wonder if just when you're put into that position, if you're just, I like the idea of a certain amount of income that's coming in. And so I see why people are drawn to it.
Right.
But it doesn't seem like a good deal when there's all these other things you could do. So.
Right. Yeah. It's very much an appeal to somebody who doesn't know what the other alternatives and the other options are. Or maybe, to give those folks credit, maybe there isn't anybody that they can turn to.
Right.
Maybe they don't know, hey, it is kind of complicated putting a portfolio of stocks and bonds together. I think both of us feel like it's not, and there's resources out there to make it simple.
Right.
But if you don't have access to those resources, you're not aware of those resources, it can be, well, how do I do this correctly? But it's all an appeal to, well, you don't know how to do that. I don't bother with that.
We'll take care of it.
Right. And to be honest, annuities, it's easy to create the sales pitch for the annuity. And that's part of why they're prevalent. And then again, they're sold aggressively because the commissions are so crazy. And so, I think the only other, and kind of this is what the article that we wrote is about mostly, are these immediate annuities where, the idea, and I guess, our article kind of touches on pretty much all of these themes, but the immediate annuity is where, okay, here's an actual feature that exists within this product that doesn't explicitly exist within a portfolio of stocks and bonds, So if I hold a portfolio of stocks and bonds, 60% stocks, 40% bonds, something like that, I'm going to invest my money. I'm expecting to earn some return on that, and I'm expecting to withdraw some money from that. That could go well, that could not go well, right? Well, here's an immediate annuity. Don't worry about it. Purchase this policy, and you'll just get a check in the mail once a month, and you won't even have to think about it.
Right.
Well, that is a legitimate difference between these two things. I certainly have some thoughts on that, but why might you have any thoughts in terms of why you might want to go with the more traditional approach as opposed to going with something like that?
The potential gains that you can get with.
That's a really good point.
Yeah.
Yeah.
I mean, that's what I would think of.
Yeah. Yeah, certainly. It's, you don't want to be, generally you probably don't want to be invested, in such a way where it's like, I'm crossing my fingers hoping this thing doubles, over the next 5 years. But that is a legitimate point. Like, if the markets outperform, that's your money. Like, that's not, whereas if you give all that money to the insurance company, that's the insurance company's money now.
Right. Yes.
So good for them. Not so great for you. But we have a lot of tools, right, that we can use to say, here's how I'm invested. Here's how much money I've got. And is this going to give me the income that I need over the next 10 or 15 years?
Right.
And so there's some really good resources out there for if you are wanting to figure out, well, how do I do this well, and how do I not give into this fear of I might mess it up, right?
Right.
It's really not that hard.
Yes,
Right,
we
Michaela?
have. You might be leading me to water. Is it our investment tool? So, and that's.
I'm thinking more of like our income needs analysis.
Okay. So I do like our income needs analysis, and because there's a variable that we can change depending on what type of portfolio you have. So say more aggressive, we're going to look at a certain rate of return compared to an ultra conservative.
Mm-hmm.
And so if you are naturally conservative, we could utilize that typical return and foresee or really kind of get the most probable and the most likely outcome for how much money you're going to have when you retire, but also how long is it going to last. And so, is your portfolio going to generate enough for you to live on and still have money at the end of your retirement? And so having a tool like that is really, really nice.
Mm-hmm.
And then what I also like is that second component is looking at the investments that you're in and saying, okay, am I going to get X amount of return based off the portfolio I have?
Mm-hmm.
Because if you're looking at an aggressive rate of return and you're super into fixed income, that's not likely.
Right.
So
right.
I really like, yeah, absolutely.
Yeah, but like that tool there is, 15, 20 minutes to go through it.
Right.
And that is your answer for, the fear that the immediate annuity, lives on, which is,
there you go. Yeah.
I'm so afraid I'm going to run out of money. And so the annuity person says, well, I've got a solution for you. 15, 20 minutes with us to run through this analysis to say, here's where you're at. Here's how much you need. Right. Is this a good plan or not? We can resolve that as well. Right. And then you don't give up the optionality, right? Mm-hmm. And here's the biggest reason I think the immediate annuity, you don't want it, is that, let's say you go to the insurance person and they say, you've got however much money, hey, we'll send you a $3,000 check in the mail each day. You go, my goodness, $3,000. That's great. I think that'll do. I can live off of $3,000, if you get some extra from Social Security or whatever, depending on whatever situation you're in, whatever numbers make sense to you, you go, that's a good deal, I'll take it.
Right.
That $3,000 doesn't change.
Yeah.
It's $3,000 this year, it's $3,000 next year, the year after that, the year after that. Hey, what happens maybe if we get into a war with Iran and gas prices go up and energy prices go up, and maybe inflation shows up. Maybe inflation's, inflation, the difference between 2% inflation and just 3% inflation, you get to totally different how much things cost after 10, 15, 20 years.
Right.
And so, even if you just look today, how far $3,000 a month took you 20 years ago versus $3,000 today, it's a huge difference.
Oh yeah.
And so that's the, but our whenever we run our analysis, we assume that the cost of living is going up. We're assuming not a static $3,000. We're assuming that's going to grow with inflation over time.
Yes.
And that's the benefit of a well-diversified portfolio.
Right.
And approaching it the right way. Anything else, Michaela, from your end that you feel like we need to cover or haven't touched on? Any other questions that people have asked about this topic that we didn't address?
Yeah, and I said this at the top when we started talking about the article. Is I don't think that annuities are the devil, and they may be a part of the retirement planning, but it should not be your entire. And I feel confident. That's how I feel. And I feel confident saying that, especially if inflation is a worry to you. $100 today, it's not going to be $100 tomorrow. And I'm going to say it again, diversity, right? Diversification, super important.
Right. Yeah, no, that's great. And I agree with, it can make sense under the right parameters, but the way it's used is almost always 100% of nothing. And do I think it's the worst thing on the planet to put 10% of your portfolio into an annuity? No, it's not. You're going to be okay. You won't see me
suggesting that.
Yeah, or taking client assets and doing that with it, because I just don't think it's the best way to have your money work for you. But
especially because they're going to invest in the same investment you would have invested in if you were just using it.
Right. Yeah. No, that's exactly right. When you give the insurance company that money, what do they do with it?
Yeah.
Well, they go invest it the way that you should have from the beginning, and then they charge you a fee for the honor of doing that. But well, this was a fun one. So a lot of hot takes and thoughts and perspectives there. Again, check out our article at RetireAdvisers.com that goes into all of this. And hey, if you've got any questions and you want to run through any of these scenarios or situations that we, using these tools that we talked about today, that's available for you. Just go to our website, RetireAdvisers.com, click schedule, and we'd be happy to help you out. So thank you so much for taking some time out of your day, and talk to you soon.